One is what I'll call the private sector view. The public sector view of how that you have to be heavily regulating the private sector. And so this is a quote from an economist who you've probably all heard of, Joe Stiglitz. He's won the Nobel Prize. He's a relatively liberal economist. He's brilliant in his own way, and he writes in defense of what he calls the public interest view. Financial markets, as I've just explained, are markedly different from other markets. And he says that market failure is more likely to happen, it's more pervasive than in other parts of the private sector. The market doesn't work very well when it comes to finance relative to other private sector activities. And therefore, there exist forms of government intervention that not only will make these markets function more efficiently and better, but will also improve their performance. This is the rationale for heavy government intervention in the financial sector. Because market failure happens more often for reasons which we'll explain. And the consequences of that market failure are much more far-reaching, as we've already explained. And therefore, the government must intervene and must have a very heavy involvement in it. And he talks about why markets fail. And the one word he uses most often, and this is why he won the Nobel Prize, by the way, he wrote about this back in the 1980s, about something called information asymmetry. And it gets back to what Frank was talking about in terms of principal-agent problems. And this is a classic example of principal-agent. What it means is that one side of a financial transaction controls the information, and the other side of the financial transaction is totally dependent in order to make a decision. So if you are a company and you want a loan from a bank, you are the principal. The agent is the bank who is being asked to lend you money. And that bank is making a decision about whether or not to lend you, as a company or an individual, that money based on the information that that company or that individual gives to you, the bank. And on the basis of that information, they will decide yes or no, I'll lend. And more importantly, I'll charge 5%, 6%, 7%, 8%, because I'll take that information, I'll analyze it, I'll decide what the risk is, and then I'll make a decision. But who controls that information? The principal. So there is an imbalance in that critical information. Information is the lifeblood of these decision makers. Everything they do depends on the quality of the information they receive from the other side. And information asymmetry is vast in finance. And so Stiglitz is saying, because of this gap, because of this asymmetry, because of this principal-agent problem, you have to intervene to mitigate some of this risk. Now, if there is a problem with what our Nobel Prize-winning economist is saying, he is making implicitly the assumption that the government is capable, has the capacity to do what it says needs to be done. He never talks about, he talks about market failure as the rationale. He doesn't talk about another kind of failure. And the other failure is government failure. The government may be very well-meaning, very well-intentioned, but does it have the capacity to do what it says has to be done? This gets back to Frank's first lecture about capacity. And so there was a second point of view. And ironically, at least to me, this second point of view comes from none other than the World Bank. World Bank people generally are very, very in favor of state intervention and state doing this and state doing that. And this is a quote from some World Bank experts in the financial sector, and they have a completely different point of view than Professor Stiglitz. And theirs is, we'll call the private interest view. And they say, we who are looking at this, that empowering official supervision, government supervision of banks does not improve bank development. It does not improve bank efficiency. It does not reduce corruption in bank lending or lowering costs in banks. Indeed, our evidence from looking at banking systems all over the world, mainly the developing world, suggests the opposite. Many countries' political systems produce policies that maximize the welfare of the politically powerful, not social welfare more broadly. Does this sound familiar? So they're saying, sure, if we lived in a perfect world, Stiglitz would be right. But we don't. And government capacity is limited. And special interests, vested interests, the status quo, impede the ability to do what Professor Stiglitz says we should do. And therefore, regulation of financial institutions doesn't work very well. Weak government capacity, what we call regulatory capture by special interests, usually wins the day. And governments don't end up doing what they say they want to do. And so this makes the job of a regulator of financial institutions and markets unbelievably challenging, unbelievably difficult. But to some extent, we would say that that's true of all private sector activities, not just finance. But finance is different. Finance is different for some very, very specific reasons that explain why it's a nightmare to be a financial regulator. I'm hoping Jose will agree with this, that his job is really, really tough. Some would say impossible. And it's impossible or very difficult. I won't say it's impossible. It's very, very difficult for reasons that are specific to the financial sector. And I think you should understand a little bit about it. One is, the first one here, what we call regulatory capture. This happens in other parts of the private sector also, where there are special interests that are well-financed and very skilled at influencing regulation. And the financial sector is a perfect example. The financial sector is very rich. They got lots of money. They are very, very effective lobbyists. And their job is to reduce regulation to its lowest common denominator. And that, by the way, is not just in finance. If I had 50 business persons in this room from different sectors, not just finance, could be computers, it could be automobiles, it could be agribusiness, and you're all chief executives of companies in the private sector, and I said, how many of you are in favor of regulation? I don't think one hand would go up. No business person likes regulation. No business person likes government oversight for lots of reasons. Not only is it a pain in the neck, regulation costs money, real money. Whether it's in banking or something else, there is a cost, a financial cost associated with, which explains why no one likes regulation. But the regulatory capture in the financial sector is extraordinarily high. There is also what we call moral hazard. And Marcos was talking about the rule of unintended consequences before. And that with public policy across the board, there are unintended consequences of public policy that is very well-intentioned, very well-meaning. So let's take, for example, the subject of deposit insurance. You have it in Brazil. Most countries have it. You go to a bank and you take your hard-earned savings, which are the most important thing you have, and you put it in a bank. And you pay absolutely no attention to the quality of that bank because you know that if that bank does not perform well and that bank fails, you'll get your money back. What would happen if there was no deposit insurance? What would happen if you would lose your money if that bank performed poorly? Well, the probability is that you would spend a lot more time scrutinizing where you put your hard-earned savings, and that would be an incentive for the bank to be more careful and perform better and take less risk. But the bank also, knowing that that deposit insurance exists, has less incentive than it otherwise would to perform in a way that is less risky and protects your savings. So there are these unintended consequences, what we call moral hazard, when we talk about finance. And there are a lot of examples in finance of moral hazard. We talked a lot earlier about globalization. It's a very controversial subject right now. But globalization means that it is, in the context of finance, and which makes it very difficult for regulators in a domestic economy, is that if a financial institution feels that they're being excessively regulated and it's very costly to do business, what do? They move to another country. And in finance, given the nature of the product, money, which is intangible, it's very easy to move from one jurisdiction to another for the purpose of lowering the cost of regulation. And that makes the job of the domestic regulator, makes the job of Jose very, very difficult. Because if he over-regulates banks in Brazil, they're going to move most of their activity offshore. And when they move their activity offshore, he can't supervise them very effectively. And we have countless examples in finance of regulatory arbitrage, which is a function to a large extent of different regulatory regimes which have been facilitated by globalization. And so these things make it very, very difficult. But there's another factor in finance that I think explains why it's a nightmare to try and regulate it more than any other, and that is the nature of the product we are dealing with. Money. You can't kick it, you can't feel it, you can't store it under your desk or in a drawer. It's basically an accounting entry. It's a computer entry. It is the easiest of all products in the world to hide, to move without any cost. With the click of a mouse, you can move millions, tens of millions, billions of dollars from one country to another. It's so simple with money because of the nature of the product to avoid regulation, to be corrupt, to conduct fraudulent activity. There's no other private sector act, no other activity in the world where it is as easy to manipulate the product for any one of a number of different reasons. Because it is so opaque, it is so intangible. And imagine if you're Jose or any other regulator, this makes your job virtually impossible. How are you going to monitor? How are you going to govern this activity when it is so easy to move this money around with the click of a mouse? And so it's very, 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 very difficult. Another reason why this is tough, because of everything we've just said, is you need really skilled people. And I will tell you that people say that in the United States we have pretty good human capital. And we have lots of very, very good people who go into government, who get trained in the best graduate schools in finance. And they are financial regulators, and they are central bankers. And I will tell you that they are always far behind the curve. That's in the United States. This is we've said this is a very regulatory intensive part of the economy, and it's a very skill intensive activity. And we in the United States struggle, usually unsuccessfully, to keep up with what's happening in the financial sector. And if it's true in the United States, which is relatively well developed, give us the benefit of the doubt for a minute, think of how difficult this is in most other countries. Meaning how hard it is to attract and retain highly skilled people that are motivated, that are honest, to do this type of activity. It is really, really tough. It is really, really tough. We have tremendous difficulty in the United States to doing it, and that's the tip of the pyramid. It gets harder and harder. So the human capital constraint in the financial sector for government is just unimaginably difficult and challenging. And we have to be somewhat sensitive to that. Finally, I would mention the problem for regulators, which is almost irresolvable, is maintaining a level playing field, which is to say we have a doctrine or a concept in finance called too big to fail. Too big to fail. We're talking about financial institutions. And what happens because of everything I've just told you so far is that we cannot allow certain very, very large financial institutions, be it in Brazil or in the United States or any other country, to go bankrupt because of the far-reaching systemic consequences of their failure.
Isn't that a moral hazard?
Yes.
Oh.
That is a moral hazard problem. That is an unintended consequence. Just a second. Let me just finish the thought, and then Marcos can have the floor. So there is no level playing field in finance in any country, in Brazil, in the United States, or anywhere else, because we want to treat everybody equally. We want to have the same rules and regulations for all financial institutions. And when in the newspaper, if you talk to a financial regulator, they say we treat everybody equally. There is a level playing field. In reality, there's not a level playing field because we have this too big to fail problem that we've never figured out how to solve. So those institutions that are very, very large, like Citibank or Itaú or Bradesco, that have these thousands of financial relationships and are systemically important. They're systemically more important than small and medium-sized banks. As a government, you treat them differently because you're more nervous that if they fail, the consequences, the systemic consequences, are much more far-reaching for the financial sector and for public welfare. And this is unique to finance to some. So there's just one other thing I'd like to mention about this, and this again goes back to other things we've talked about in this course over the last 3 or 4 days, and that is that as you've discovered, you know this, but it's certainly true in finance. We've discussed it in different contexts during this course, but let's be specific that the mindset of a government official is very, very different. What motivates them, what incentivates them is very, very different than someone in the private sector. We've talked about this throughout the work, but let's be a little bit more specific. If you are a government official, hopefully you are interested in the public welfare. And in the financial sector, hopefully, your job description involves mitigating risk, encouraging financial stability, making sure that there isn't undue damage done to the public welfare if a financial institution fails. The cost of the regulations that you are responsible for designing, implementing, are secondary. You don't really think that much about it as a government official. You're more concerned about, as you should be, about protecting the public, encouraging financial stability. reducing or mitigating the risks involved in finance. You may be concerned about costs, but it's not your primary concern and it's not your priority. Now you flip into the private sector, and as we've talked about throughout this course, their mindset their motivation is totally different for understandable reasons. It's not right or wrong. As was said yesterday, they want to make a profit. They don't necessarily, most of them don't want to break the law. They want to do things the right way, but this is not how they spend their day. When they get up in the morning and they go to work, this is not what's on their mind, the public welfare. What's on their mind is, how do I maximize the profitability for my shareholders, for my bank, and therefore increase my bonus. That's what they do every day, as you would expect. So this creates a tension, always, not just in finance, by the way, but across the board between the private sector and the public sector, and it does create a set of challenges for everybody when you have this type of tension that is inherent in a market economy between different types of people. So now, that's all I want to say about the financial sector. You've just been taken through Finance 101, and I hope that this gives you a little bit of a sensitivity, number one, to how the financial sector works, the basics, the ABCs of how the financial sector works, and number two, how very, very difficult it is in government to oversee, monitor what happens in the financial sector. The financial sector is different than other private sector activities, and it's more difficult to regulate. And the consequences of failure are much more far-reaching for the public welfare than anything else that goes on in the private, in a market economy. And those are the takeaways from this first few minutes we've spent together. What I'd like to do now is to just very, very briefly, now that you know so much about finance, make the point simply that economic development, poverty alleviation is directly, not indirectly, directly linked to how well or not this financial sector performs. You can't have one without the other. And again, now you've seen that it's quite difficult to do this. Now, the first, I think, point to understand is that we talked initially about savings. Most of the investment in any country, whether it be Brazil, United States, any country in Africa, most of productive investment does not come from outside the country. It comes from domestic savings. More developed countries, maybe you can attract more foreign investment. But the biggest bulk of investment is going to come from within the country, from domestic savings of that country. And that requires that people in that country have enough trust and confidence in the financial institutions and markets in that country that they are willing to give their savings to those institutions for safekeeping, and then that those financial institutions do their financial intermediation function well. But what we find in developing countries, and I think this is true to a certain extent, I don't have the data in front of me for Brazil, but there are vast numbers of people in developing countries, and even in Brazil, which is a middle-income country, that don't go near a bank. Either they don't trust banks, or they don't know how to use them, they don't understand them. And I would argue that in most cases, it's not because they don't have any money, any savings. Most people in most countries have some savings. Maybe not a lot, but some. But there's this lack of trust, there's this lack of understanding that makes them unwilling or unable to use the formal financial system. What does that mean? That means that that is savings, that is money in the economy that's not being intermediated and that has no chance whatsoever at any point of being intermediated and put into productive investment that grows the economy. And this is a huge problem in most developing countries. So this also, because they're not using the financial sector, this aggravates another problem, which is inequality. They're not using the system, and that means they're not earning anything on their savings. And you're deepening inequality when you have so many people in the country that are not using the financial system. You have low domestic savings, but you have even lower utilization of the financial sector. And this creates a tremendous, tremendous problem. So somehow the big challenge in all countries, and even in Brazil, is how do you get more people to use the financial sector, the formal financial sector, not the informal? And how do you get them to have better access to the financial sector and the financial institutions so that they can, it's win-win when this happens. And this is what we would call, you've heard this term before in this course, a virtuous circle. So when you have a virtuous circle, you have more and more people that have confidence and trust in the financial sector. They put their savings into financial institutions. The financial institutions use that money productively. This is what the textbooks tell us anyway. The productive investment will generate growth in the economy. But more than that, those people who use the bank will gain also individually. It does reduce poverty. It does reduce inequality in the country. But it requires these people to use the financial sector, to have trust and confidence and understanding of how that financial sector can help them.